Welcome to an in-depth exploration of CBDC, central bank digital currency. Acknowledge the growing interest in digital currencies and highlight the significance of CBDC in the evolving financial landscape. What is a CBDC and how does it differ from traditional currency? A central bank digital currency, CBDC, is a form of digital currency issued and regulated by a country's central bank. Unlike traditional currency, which exists in physical form, such as banknotes and coins, and digital form, in bank deposits and electronic transactions, a CBDC is a purely digital currency. Key differences between CBDC and traditional currency include digital nature. CBDC is entirely digital, existing in electronic form only. Traditional currency, on the other hand, has both physical, cash, and digital, bank deposits components. Centralized issuance. CBDC is issued and regulated by the central bank of a country. Traditional currency is issued by both the central bank and commercial banks, and its supply is influenced by various economic factors. Direct liability of the central bank. CBDC represents a direct liability of the central bank, making it a liability on its balance sheet. Traditional currency, especially physical cash, is also a liability of the central bank, but digital forms, bank deposits, are liabilities of commercial banks. Controlled and regulated. CBDC is under the direct control and regulation of the central bank, allowing for more centralized oversight. Traditional currency involves a combination of central bank policies and commercial bank activities. Programmable features. CBDCs may have programmable features, allowing for smart contracts or automated functionalities. Traditional currency lacks these programmable features. Potential impact on monetary policy. CBDCs could potentially provide central banks with additional tools for implementing monetary policy, offering more direct control over money supply and interest rates. Traditional currency relies on indirect mechanisms, such as open market operations. It's important to note that CBDCs are still in the exploration and development stage in many countries, and the specific features and implementation may vary from one jurisdiction to another. The introduction of CBDCs raises various considerations, including those related to privacy, security, and the overall financial ecosystem. Which countries have already implemented or are planning to launch CBDCs? Here are several countries that have either implemented or are actively exploring the development of central bank digital currencies, CBDC. Keep in mind that developments in this space may have occurred since then. Here are a few notable examples. China, People's Republic of China. China has been at the forefront of CBDC development and has conducted extensive pilot programs in major cities. The digital currency is known as the Digital Currency Electronic Payment, DCEP, or digital yuan. Sweden's central bank, the Riksbank, has been researching and testing the e-krona, its potential CBDC. They are exploring the implications and technical aspects of introducing a digital currency. Bahamas. The central bank of the Bahamas launched the Sand Dollar in October 2020, becoming one of the first countries to officially introduce a CBDC. The Sand Dollar is a digital version of the Bahamian dollar. Eastern Caribbean Currency Union, ECCU. The Eastern Caribbean Central Bank, ECCB, launched the Dcash, a digital version of the Eastern Caribbean dollar, to facilitate faster and more secure transactions within the ECCU. European Union, EU, the European Central Bank, ECB, and several national central banks within the EU have been actively exploring the possibility of launching a digital euro. Pilot projects and investigations are ongoing. United States. The Federal Reserve in the United States has indicated interest in exploring the potential for a digital dollar. So far, 9 U.S. financial institutions, including Citibank, PNC, TD Bank, Wells Fargo, and MasterCard, launched a pilot program working with the Federal Reserve Bank of New York to test the feasibility of a digital dollar based on distributed ledger technology. Jamaica launched its Jamdex Central Bank Digital Currency, CBDC, into production in April 2022. The Bank of Jamaica has connected with Ireland-based software firm eCurrency Mint as the chosen technology provider, United Kingdom. The Bank of England has been researching and discussing the concept of a digital currency known as the digital pound. While no official decision has been made, the topic is actively considered. Japan. The Bank of Japan has announced plans to experiment with a digital yen to better understand the technical and regulatory challenges associated with CBDCs. These are just a few examples, and the landscape is dynamic. Other countries, including Canada and Singapore, have also expressed interest or initiated studies regarding CBDCs. It's advisable to check the latest sources for updates on specific countries' CBDC initiatives. What are the advantages and disadvantages of CBDCs? Central bank digital currencies, CBDC, come with various advantages and disadvantages, and their impact can vary depending on the specific design and implementation. Here's an overview. Advantages of CBDCs. Financial inclusion. CBDCs can enhance financial inclusion by providing a digital currency accessible to a broader population, including those without traditional bank accounts. Efficiency and speed. Transactions with CBDCs can be faster and more efficient compared to traditional banking methods, reducing settlement times and improving overall payment system efficiency. Reduced transaction costs. CBDCs have the potential to lower transaction costs for both individuals and businesses, particularly for cross-border transactions. Direct monetary policy tools. CBDCs can provide central banks with additional tools for implementing monetary policy, allowing for more direct control over money supply and interest rates. Security and transparency. CBDC transactions can be secure and traceable, reducing the risk of fraud and enhancing transparency in financial transactions. Enhanced cross-border transactions. CBDCs may simplify and expedite cross-border transactions, reducing the need for intermediaries and currency conversion fees. Disadvantages of CBDCs. Privacy concerns. CBDCs raise concerns about user privacy, as digital transactions can be traced and monitored. Striking a balance between privacy and regulatory needs becomes a challenge. Operational risks. The digital nature of CBDC makes them susceptible to cyber threats, hacking, and operational risks. Ensuring robust cybersecurity measures is crucial. Impact on commercial banks. CBDC could potentially lead to a reduction in bank deposits if individuals choose to hold their money directly with the central bank. This may impact the lending capacity of commercial banks. Technological barriers. Implementing and maintaining a secure and efficient CBDC system requires advanced technological infrastructure. Developing countries may face challenges in adopting such technologies. Interest rate challenges. The introduction of CBDC may affect traditional interest rate tools, requiring central banks to reconsider their strategies to maintain control over monetary policy. Potential for bank runs. If CBDC offer advantages over commercial bank deposits, there could be a risk of bank runs, where individuals rapidly withdraw funds from commercial banks to hold CBDCs. Complexity of implementation. The design and implementation of CBDCs require careful consideration of legal, regulatory, and technical aspects, making the process complex and challenging. It's important to note that the advantages and disadvantages can vary based on the specific design, policies, and safeguards put in place for CBDCs. Countries exploring or implementing CBDCs need to carefully address these factors to ensure a balanced and effective digital currency system. How does a CBDC impact traditional banking systems? The impact of a central bank digital currency, CBDC, on traditional banking systems can vary depending on its design, policies, and the regulatory framework. Here are some potential ways in which CBDCs may influence traditional banking systems. 1. Competition with commercial banks. CBDCs could potentially compete with commercial banks for deposits. If individuals prefer holding CBDCs directly with the central bank, it might lead to a reduction in commercial bank deposits, impacting their ability to lend. 2. Changes in money supply and monetary policy. CBDCs may impact the traditional tools of monetary policy. If individuals shift funds between CBDCs and commercial bank deposits, based on interest rates and other factors, it could complicate the control of money supply and interest rates by central banks. 3. Impact on interest rates. If CBDCs offer interest rates that are more favorable than those offered by commercial banks, individuals might choose to hold their money directly with the central bank. This could affect the traditional transmission mechanisms of monetary policy through interest rate adjustments. 4. Potential for disintermediation. If CBDCs offer similar functionalities as commercial bank deposits but with perceived advantages, there's a risk of disintermediation. Individuals may bypass commercial banks to transact directly with the central bank, affecting the traditional banking business model. 5. Operational changes for banks. Commercial banks may need to adapt their operational models to account for the introduction of CBDCs. This includes changes in payment systems, settlement processes, and technology infrastructure to remain competitive in a digital currency landscape. 6. Enhanced cross-border transactions. CBDCs might facilitate more efficient cross-border transactions, potentially reducing the reliance on commercial banks for international transfers. This could impact the revenue streams associated with foreign exchange services offered by traditional banks. 7. Integration challenges. Traditional banks would need to integrate CBDCs into their existing systems, which may require significant technological upgrades. Ensuring interoperability between CBDCs and existing banking infrastructure is crucial for a smooth transition. 8. Impact on financial stability. Changes in depositor behavior, such as a rapid shift from commercial bank deposits to CBDCs during times of uncertainty, could affect financial stability. Regulators would need to monitor and manage potential risks. 9. New opportunities for banks. On the positive side, the introduction of CBDCs could create new opportunities for banks, such as providing custodial services for CBDCs, developing innovative financial products, and adapting their business models to the evolving digital currency landscape. The impact of CBDCs on traditional banking systems is complex and depends on various factors. Countries exploring or implementing CBDCs need to carefully assess and address these implications to ensure a well-balanced financial ecosystem. What role does blockchain technology play in CBDCs? Blockchain technology plays a crucial role in the development and functioning of central bank digital currencies. Here are key aspects of how blockchain technology is integrated into CBDCs. 1. Distributed ledger technology. CBDCs often leverage blockchain's distributed ledger technology, DLT, which allows for a decentralized and transparent record of transactions. The blockchain acts as a shared database that is updated in real time, ensuring that all participants have access to the same information. 2. Immutability and security. The immutability of blockchain ensures that once a transaction is recorded, it cannot be altered or deleted. This feature enhances the security and integrity of transaction histories, making CBDC transactions resistant to fraud and manipulation. 3. Smart contracts. Some CBDC implementations incorporate smart contracts, self-executing agreements with the terms of the contract directly written into code. Smart contracts can automate various functions, such as compliance checks, interest payments, or other contractual agreements, enhancing efficiency. 4. Traceability and transparency. Blockchain provides transparency, as all transactions are visible on the ledger. This transparency can be beneficial for regulatory purposes and can help address concerns related to illicit activities, providing a traceable record of transactions. 5. Consensus mechanisms. Blockchain relies on consensus mechanisms to validate and agree on transactions. Various consensus mechanisms, such as proof of work or proof of stake, ensure agreement across the network, enhancing the reliability and security of CBDC transactions. 6. Privacy features. Blockchain can be designed to provide varying levels of privacy. While ensuring transaction transparency for regulatory purposes, CBDCs can implement privacy features to protect the identities of users and transaction details. Blockchain technology allows for interoperability, enabling CBDCs to potentially interact seamlessly with other blockchain-based assets and systems. This interoperability can enhance the versatility of CBDCs in a broader digital asset ecosystem. It's important to note that the specific implementation of blockchain technology in CBDCs can vary among different central banks. Some may opt for permissioned blockchains, while others may explore hybrid or fully decentralized approaches. The choice of technology depends on factors like security, scalability, and regulatory considerations. As we conclude our exploration into central bank digital currencies, it's evident that the financial landscape is evolving rapidly. The advent of CBDCs brings forth exciting possibilities for a more connected, efficient, and inclusive monetary future. As we navigate these changes, we encourage you to stay informed, share your thoughts in the comments below, and subscribe for more insights into the ever-evolving world of digital currencies. Thank you for joining us on this journey, and until next time, stay curious and embrace the future of finance.